Good morning, everyone. Welcome and thank you for joining our webinar today. This is Jyoti from My Time Equity. And in today's webinar, along with Sudhir Pai, we have with us Anup Nayak from My Time Equity. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclosure slide that our attorneys mandate that we show prior to every webinar. And we also have a QR code updated on this slide, which will take you to our WhatsApp community where you can get the daily update on our market and real estate ventures and all the funds available with us. You can just scan the QR code through your phone and join our community. If you have any questions during the presentation, please feel free to type them in the Q&A box and we will have them at the end during the Q&A session. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you very much, Jyoti. Very good morning, ladies and gentlemen. This is Sudhir Pai from Bangalore. I'm here for a few days to make some changes to our infrastructure, add some more team members, and also, work on few things that have been pending from few months. Anyways, thank you very much for joining today's webinar. The markets did pretty well during the week, but had a pullback on Friday. So the markets have been trading near the all-time highs. The S&P 500 and Nasdaq declined 0.3, but Bitcoin did gain wonderfully. It gained about 9%. Friday was a big winning day for Bitcoin. It broke the $118,000 number, and we think that this breakout is going to continue, and we could see anywhere between 125 to 130 before the end of the year. Gold was up about 1%. Most of the metals did pretty well. We saw a great breakout in silver as well, copper as well. So metals did very well. The major indices, S&P 500 and Nasdaq 100, kind of declined because of all the tariff news that came out of the White House. There was a 25% tariff on Japan and South Korea, and 35% on Canada, and many other countries getting a rate of 25 to 50%. So that deadline has been extended for negotiating with the different countries, and that date is August 1. The date for negotiating deals with the countries that have not yet closed the trade deals is August 1, and the White House has clearly mentioned that there are no further extensions. So we are in a new quarter, and the earnings for the S&P 500 companies will start coming out from Tuesday. It all starts with banking and asset managers such as BlackRock, Goldman Sachs. We should see all the earnings coming out. Earnings usually determine the strength of the stocks, the fundamentals of the stocks. And despite the headwinds, analysts have trimmed the Q2 estimates by about 5%. But despite that, the earnings growth for S&P 500 is expected to be between 9 and 13% for 25 and 26, which signifies good fundamentals and continuation of the strong momentum that we have seen in the equity markets. So technology has been doing very well. We saw good numbers coming out of all the technology companies for for the Q1, and the Q2 numbers, as we see, to be better. I think this uh, run in the market is going to continue. But please keep in mind that markets always go up and come down and go up and come down. So there is no one direction that we will see in the market. So don't get surprised, if there is a pullback in the market by about 2 to 3%, given that, we have seen such high momentum and strong upside growth in the indexes. So, seeing some consolidation, seeing some sideways movement is a possibility next week. We are seeing, support to the S&P 500 at 21-day moving average, which means the momentum is strong. And I hope this momentum continues. And that is the topic of today's webinar. Is this the top or should we take a pause? So let's continue to look at further slides and we will get into the details. Next slide, Jyoti. Okay, so is it the top for US equities? We go by seasonalities. The past and the historical numbers are our guide. So if you look at the 4-year presidential election cycle numbers, if you look at the average and then what has happened so far, the S&P 500 is clearly mirroring the historical trend, the 4-year presidential cycle term. So if this trend holds, we may see further gains in August and later. But everything is determined by earnings. So if the earnings come out well, we may be able to see a further, uptrend in both the indexes, the S&P 500 and Nasdaq 100. So the valuation is certainly a concern because we are at a valuation which has not been seen so far. But if you look at the seasonality, if you look at the momentum that we have been seeing so far, with all the uncertainties to an extent kind of coming to a conclusion on some of the tariff agreements with China and negotiations going on with a few other bigger countries. We think the upside is still a possibility, but after a sideways movement for the second half of July, because usually the seasonality says that July first 2 weeks does very well, and after that there is kind of a pause, and after that it takes off. Again, everything depends on the earnings of S&P 500 companies, which we'll start seeing from Tuesday onwards. So from a seasonality point of view, things look good. Now let's look at the earnings estimate and how has earning versus multiple growth been from the past 5 years. Next slide, Jyoti. Okay, so if you look at this slide, it clearly shows that earnings for S&P 500 remains very solid, suggesting more growth. And if you look at this chart, clearly shows that the multiple expansion played a secondary role, whereas the S&P 500 earning driven growth contributed to almost 68%. So fundamentally we are in a very strong market. And in 22, we saw a sharp contraction in multiples because very clearly the hikes in interest rates contracts the multiples, and a decrease in interest rates always increases the multiples because the cost of capital plays a significant role in the multiple calculation, while earnings growth is what we get to see the actual numbers coming out of these companies. So interest rate does play a very, very important role. So that is why we are waiting for the Fed to lower the interest rate cuts, and we will talk about that in the next slide. But if you look at this very clearly, 68% of the growth is coming from the earnings of these companies. The second is multiple, and the third is dividends coming from these companies. So very clearly earnings plays a huge role, and we hope that the numbers that starts coming out from Tuesday onwards really show continued growth of these companies, better guidances, and more confidence to the investors and continued momentum in the equity markets. Next slide. So this slide shows you that the earnings of these companies remains very strong. If you look at 2012, the earnings of all 500 companies of S&P 500 was about 105.44, whereas in 2025 the estimate is 2.64. So clearly, there is an 8.7% earning growth for S&P 500, despite analysts reducing the earning forecast by 4 to 5%. There is still a great, earning forecast for these companies. And for 2026, the expectation is around 13.6% earnings growth for S&P 500. So with all of this, there should not be any reason for the market to go downside. But as I said, the earnings that we get to see from Tuesday onwards, starting with banking and all the asset managers, will clearly give us an idea on how Q2 would be shaping up for the technology companies and sectors of S&P 500. So take one day at a time, be patient, no need for panic. Momentum is strong. Earnings will tell the truth of the strength of these companies for this quarter and the next quarter. And based on that, if there is any action to be taken, we take action. But for now, we stand strong, we stand still, and diversify our portfolio across multiple asset classes, multiple sectors, multiple countries, and let our portfolio do well. Next slide. So interest rates, this is a very important catalyst for the equity markets. While July cut is not probable because the survey markets and the betting markets and the dot plots, all of the reports show around 5% probability of a July rate cut, but there is a 75% probability for a September rate cut of about 25 basis points. Today I was reading some news and I heard that there is pressure on Fed chair to reduce the interest by about 3% before the end of the year. So that might be just a rumor, but there is significant pressure on the Fed chair from the White House and Donald Trump. But let's see what happens, because clearly Jerome Powell has been principally very clearly aligned to his thought process about the numbers to be met for further interest rate cut to happen. And there are two things that he sees. One is inflation. It should be below 2%, but currently it is 2% plus. And job market needs to break down, but job market currently is very resilient. So because both these numbers are not something that Fed is ready to compromise on, even though there is a lot of pressure from the White House, he's not willing to lower the rates because of the uncertainty of tariff and inflation cost because of this tariff. So they don't want to cut rates and then inflation pops up and we are in a very bad situation. So the Fed is waiting and watching and waiting for the numbers to show up on the reports. And let's see, how much of pressure from the White House, how much of future thinking will Fed really take into consideration and cut the interest rates, because interest rate cut will help most of the companies, large cap, small cap, mid cap, and mostly small cap and mid cap, because the cost of capital is very high right now, and that is not helping these companies expand and put more money in infrastructure and growth assets. So that is clearly one of the reasons why we are seeing real estate sector go through a little bit of pressure, and all the other sectors that needs capital is going through a lot of pressure. So we really need this rate cut to take place, and we hope September rate cut really happens, and there is at least 1 to 1.25% of rate cut before the end of this year. So let's hope that happens and markets to get a boost, and S&P 500 touching that 6,800 to 7,000 mark. All that will be very good for our portfolio. Next slide. So we are having the CPI, core CPI, PPI, and retail numbers come next week. So usually these numbers used to be very big reasons for the market volatility. But these days, we all know that inflation has been coming down. So I don't expect this to be a major, disruptant to the momentum that we are seeing. I don't see this to be disruptive. Retail sales certainly show the sentiment of the consumer. Again, here we have been seeing a little bit of mixed reporting happening. Jobless claims, again, the numbers are not to the tune of where the Fed is going to lower the interest rate immediately. So I think, market is right now just ignoring all these numbers and continuously trying to ride up because of the certainties that we are getting from all the tariff agreements and the pressure on the Fed for lowering interest rate and the strength of all the companies showcasing better results, better numbers. So most important thing out of all the slides that you saw, the number one determinant for the market to continue growth is the earnings. Second certainly is interest rate cuts coming out of the Fed, and last but not the least is certainties coming out of these trade agreements, kind of taking a pause on the geopolitical tensions that we see in Israel and Russia, Ukraine. So if those things kind of come to some kind of a certainty, I think we will be seeing a continuous growth in this equity market. But again, equity markets, they are very fragile. They are forward-seeing, forward-looking. So clearly, if there is some news, markets react. But as long-term investors, we shouldn't be reacting to such market news. We should be following the trend, and the trend right now is upwards. Next slide. So one quick request, if you are joining our webinar for the first time and if you're not part of our WhatsApp group, you see the QR codes on every slide. Please open your camera, scan that, and join our WhatsApp group, and that will give you the latest information on a daily basis. So we send a daily market summary, and we post information about our structured notes. So you will be able to get that at your fingertips, every day. This slide shows the portfolio performance of our models. On the left-hand side, you have the indexes, the market, S&P 500, NASDAQ 100, Russell 2000, gold, Bitcoin, and bonds. So clearly, if you look at the week-to-date column, other than gold and Bitcoin, all the equity indexes were down. Bond index was down. Bitcoin had a huge rally on Friday. So it was up about 8.2% for the week, 9% for the month, about 25% for the year. And gold, similarly, most other commodities also took a huge, upside position last week. But if you look at gold, it was up by about 65 basis points, month to date 1.4%, and year to date about 27.68%. So commodities are certainly rallying, whereas equities for the past week kind of took a little pause. If you look at our models, our ETF models, our growth, S&P growth model has done well. We are about 11.78% versus S&P is 7%. So we are doing well there. Even our value model is around 9.7%, so doing better than S&P. And blend, obviously, blend of growth and value has performed good too. Next generation companies, all the innovative companies, has done well, but for the week it was up, but for the day of Friday, it was down. Small and mid caps have been waiting for the rate cut to happen, and it was up 4.4% for the year. And international did very well in the first quarter, but of late, it has been taking a little bit of hit because of money flowing to equity markets in the US, growth companies, the Max 7 companies, as well as all the technology companies as part of NASDAQ. NASDAQ has really been doing well from the last 2 months, and we see that continuing because US technology companies have proved that they are strong. If there is any kind of pressure, they come back very strong because of all the AI, robotics, and all the EV technological upgrades that have been going on. And metals and crypto, our model has been doing fantastic. It is almost 27% for the year, and for the week we were up 6.79%. On all the individual stocks, most of our models are doing extremely well. They are all beating the S&P 500. If you look at S&P, it's about 7%, and if you look at all our models except for Japan, it is above 7%. And also S&P 25 is kind of lagging a bit, but otherwise most of our other models are doing extremely well. The custom model, or the models where we try to capital preserve, preservation of capital is most important for us in these four models. Margin model and IBKR custom is where most of our clients are in the custom models. We did pretty well for the week. For the week we were up by 1.13% and a margin of 1.45%. So overall, most of our models are doing extremely well, and we see that trend continuing from now on as well. Next slide. Okay, coming to structured notes, we have got a lot of structured notes here. I'll run through this very quickly. If you have any questions, please type them in the questions box, and we will take all the questions. My colleague Anup Nayak is here on the call, and he is going to patiently answer all the questions on structured notes. These notes have a very short period where you can place the trade. For example, this note, 15th July is the trade date, so we don't have a lot of time. So Tuesday is the date when this has to be placed. This trade has to be placed. So this note is linked to Nvidia, Broadcom, and Moderna, 3 solid companies, 2 technology, 1 healthcare, but extremely good companies, volatile companies, and this volatility is what helps us get this kind of returns. So this is an income note linked to these 3 companies, and we have 2 options here. You can choose one or the other. So this gives you a monthly income of 2.2% or an annual income of 26.65%, or the second one gives you an income of 1.8% or an annual income of 22.35%. So the difference between the first and second is the first one has something called as memory, which means the note remembers that you are owed certain amount of money, even if these 3 indexes fall below 40%. So the way this works is, if all of these 3 stocks do not fall 40%, you keep getting your 2.2% per month. And for any reason, if one or all the stocks fall below 40%, 40% is a big number. If it falls below 40% from the July 15th date trade price, that is when you don't get paid for that month. But because of the memory feature, if it comes back up, because anything that goes down comes back up. So let's say Nvidia goes down 40% in month 2 and comes back up in month 5. So you get paid for the months that you missed. So that's a good feature, memory feature. So you end up getting paid as soon as the market recovers. And the fixed income option is where it doesn't matter whether whether the stock falls or not, you keep getting paid this percentage. And there is a 6 months call option, which means the banks can return the money back to you, even though the note is for more than a year, this is a 1-year note, there is a call that the bank can do after 6 months, and the bank here is JP Morgan. So JP Morgan can decide to return the money back to you at the end of 6th month. But keep in mind that the bank cannot return the money back to you when the market is down. If the stocks are down and if they have not paid a particular month of coupon, they cannot return the money back to you. Banks can only return money back to you when they have paid all the month's interest, or it goes to the end of year 1. So at the end of year 1, there is a 40% downside protection. So if these stocks are all not down by more than 40%, you get your money back. And if the stock is below 40%, then you will be getting the remainder. So let's say Nvidia is down by 60%, you get only 40% back, but you would have earned your interest. So compare this to investing in Nvidia directly. Nvidia will not give you dividends of this magnitude, 2% per month, nor does Broadcom does or Moderna does. But here, if you're looking for income on a monthly basis with some kind of certainty, which is what we get through memory and fixed income clause or the features, you end up earning good income every month. And these structured notes are liquid. If you want to get out of it any day, you can just tell us and we can sell this in the private market. When you try to sell this in the private market, you may not get the best price, but still it is liquid. It depends on the price of the underlying stock. If Nvidia, Broadcom and mRNA, Moderna, if all the 3 stocks are up and you want to sell, certainly somebody will buy it, right? But let's say if these stocks are down and you want to sell, the buyers are going to ask for a discount. Now, how much is that discount? We don't know, but certainly, it's a liquid stock. It's a liquid instrument. Unlike investing in ventures or real estate where there is no liquidity, here there is liquidity. So this is an income note. So the first option. Next slide. Okay, so the next slide here is a principal protected note, which means your principal is not at risk, and it is also FDIC insured, which means like a CD, this is completely protected against any kind of risk. So here we have 4 notes, we have multiple options, we have 4 CDs linked to 4 different stocks. The 4 stocks are Tesla, Nvidia, Amazon, and Microsoft. If you tell me, hey, Tesla, why do I want to bet on Tesla? Because Elon Musk is fighting with Trump all the time. Then don't look at it. Think of Nvidia, Amazon, or Microsoft. So these are options for you. So this is a 3-year term note. It's a principal protected FDIC insured note issued by HSBC. The date to trade this is July 31st. Now the way this works is, let's say you are into Nvidia note. It's a 3-year note. At the end of 3 years, so it doesn't give you any income or any growth year on year, but it gives you income at the end of 3rd year. At the end of 3rd year, if Nvidia is up by, let's say, 100% over 3 years, you get 100% participation, but up to 28%. So your return is 28% over 3 years. So your question is, why should I be investing in this? Because the returns are about 8.5%. Because the treasury that is safe, FDIC protected, gets you about 4.2, 4.3%. CDs also get you that. Whereas here you have a potential to make up to 8.3%. And if you look at Amazon, even that's about 8 point something percent. Microsoft 22.25% over 3 years. So this certainly gets you extremely good returns, and all these 4 companies have been doing well, and our hope is that it continues to do very well, and your money is safe, protected, FDIC insured, and you get a much higher return than what treasuries would give you, or a CD would give you, a bank CD would give you. Also keep in mind that we are talking about the federal government reducing interest rates further. So right now it's 4.5%. If it goes to 3, then you are stuck with 3. Whereas here, if you sign up for this note, you have an assured growth if these 3 companies grow. Again, because of the protection it is giving on the downside, FDIC, the returns are not going to be in the 20% per year. but certainly 8% is not bad for the protection this offers. Next slide. So we have a few variants of S&P 500. We all know that S&P 500, the market index, does well, but S&P futures index, this is a index which is a little bit more aggressive than S&P 500 because it's the futures index, and it has 35% extra volatility and 6% decrement. Little technical, but we can explain it to you if you're interested. But all in all, what I can say here is this index does better than S&P 500, upside and downside both. When the S&P falls, this falls higher more than S&P, but when it goes up significantly also. So this takes on more risk and more reward. So here what happens, this is a 3-year note, 5-year note, multiple options are there. You will get anywhere between 15 to 12 to 15% return every year. So a much higher return. That means you have no chances of losing your money. But at the end of 1 year, if this index is flat or positive, you make 15% in note 1, and in note 2 you make 26.25%, in note 3 you make 12%. Why are there differences? Because of the term. The first one is a 3-year term, the third one is a 5-year term. The second one, which has 26.25%, does not have full protection of 100%, but it has protection of 50%. So more risk, more reward, and this can be explained better by Anup, my colleague. And if you have any questions, if you have invested in this, please do ask us questions, and happy to answer them. But I request Anup to explain this in detail when he starts talking. Next slide. So we all know that the big beautiful bill got passed, and the highly anticipated bonus depreciation for business owners and real estate professionals did get approved. If this bill had not got approved, the bonus depreciation on real estate, plant and machinery, fixed assets used for business, the deduction was limited to 40%. But with the extension of this Tax Cuts and Jobs Act as part of BBB, the big beautiful bill, the bonus depreciation on assets purchased after January 20th, 2025 now stands at 100%, which means if you buy an asset including a car wash, and the reason why we are showing you car wash on this slide is because we have this real estate asset available for purchase. What happens when you purchase this asset? So it's a $5.36 million car wash. We get a loan of about 60%, which means about 40% comes out of your pocket, which is around $2 million. The bonus depreciation on this whole car wash is about 100%. Land does not get depreciated, so most of the cost of the property which is in the building gets written off in year 1, and that benefit coming out of federal tax of 37% is about $1.57 million, which means effectively you're putting about $500,000, and this $500,000 worth property after depreciation benefit generates about $380,000 per year, which shows about 22% cash flow net of bonus depreciation benefit. But excluding that benefit, assuming that you are not taking into consideration the depreciation benefit, your cash on cash return is about 6.2%. So this is a beautiful investment. Car washes are kind of essential service. Most of the car washes don't have too much of manpower to manage them. It's all electronically powered. So these are good investments for writing off and lowering your taxes, federal and state. Here we are only showing the benefit of federal tax, but even the states recognize depreciation and bonus depreciation. So long story short on this, this investment lets you write off, get you the tax benefit, and gives you about 6% income. And when we sell the property, it gives you the growth. Now we can help you buy these kind of car washes. The minimum investment required for this kind of investment is around $250,000 if you want to invest in such an asset directly. Or we also have a car wash fund where the minimums are $25,000, but you won't get high depreciation the way you would purchase and own a property, because funds will have its diversification, as well as the cost of running the fund, the cost of the managers charging the fees. So owning the asset versus investing in a fund, owning the asset makes sense to those who have cash to invest in bigger assets. But if your liquidity is limited, then we have the fund investment. But car wash is a good investment now till end of the year. Usually to buy these kind of asset, it takes about 3 months from the time we decide to buy to due diligence to bank loans, structuring, purchase, and to take the benefit before the end of the year for 2025. So talk to us if you're interested in this car wash. We have about 8 of them, and we can help you with the buying one of them or more of them. Next slide. Next slide, Jyoti. Okay, so that brings us to the end of this webinar. Again, as I requested, please scan this QR code, join the group, get daily updates, information about different opportunities that we bring to the table. And please do post your questions in the Q&A or the chat box, and we will answer them shortly. So we talked about how the markets did. We talked about how the markets might do minus the earnings that we are going to see from Tuesday. We talked about multiple structured notes. We talked about the big beautiful bill in the car wash, and similarly we have gas stations. The tax planning season is on, so we have a lot of opportunities right now, whether it's oil and gas, charitable contribution strategies, standard tax planning ideas such as putting money into your 401k, defined benefit plan, and things like that. So please send your questions, post your questions, and we will answer them now. Thank you. Anup, over to you.
Yeah, thanks, Sudhir, for the detailed webinar, mainly focusing on to look out on the earnings, and then we also spoke about interest rates, and this could be the movers and shakers of the market, and we also spoke about the structured notes, and finally the opportunity towards tax advantage car washes. So there are a few questions coming up, and we also have some of time because we need to get into something else very shortly. So we'll keep the questions short, and but we assure that in case if there are any questions unanswered, we'll get back to you either through a mail or a call. And Jyoti, you're able to hear me, right? Yeah.
Yes, yes.
Okay. Thanks. So yeah, first question is on Tesla. So yeah, first question was on Tesla. If Tesla goes down by 50% in FDIC note, do we still get our principal back? The answer is yes. It's not because it is FDIC insured. FDIC insured is primarily it is mitigating the credit risk of the bank, but you get the principal back because it is 100% principal protected. That is the prime reason why you'll get your principal back. Next is, what are your thoughts on Moderna stock giving the pushback on vaccines by health department and COVID vaccine is fading out? Yeah, so definitely out of the three, Moderna is the volatile stock. And that is typically how you are able to get high yield both for memory and fixed income. So yeah, please have a look, and you can take informed decisions considering the details that we have given. So that is about the Moderna stock. Next is when I go to Structured Notes website, we used to see the brochures, but nowadays we don't see them to include the brochures along with the notes link. Yeah, so we will definitely, we are working on that. We are in fact revamping the website as well, and so we should be having those details shortly back up and running. And there are a few questions that we'll get back to you in terms of the digital fund NAV. So we'll get back to the respective client who has asked that questions. And then there is also an questions on 1031 exchange between selling a single family rental car. So we will get back on that as well. And I think there's an update on Perplexity investment as well. So we'll get back on those things. So these are a few of the questions that we have had. If there is any questions, we can stay here for about a minute or so. But otherwise, feel free to get back to us. And if Jyoti, if you want me to quickly go through that slide for the note that Sudhir was speaking where he wanted me to explain, I can quickly do that, please. Yeah, so I know Sudhir sort of explained, but just to recap on what he explained, most of the fund, these are all S&P variant stocks. At least this is one of them is S&P 500 futures 35% defined volatility, which is offering, this is from BNP Paribas, which is offering 100% protection and 50% protection. So in case of 100% protection, what happens at the very first line item or the note 1 is that if S&P 500 futures 35% defined volatility, if it is up, flat or positive on July 31st, 2026, because all of them are trading on July 31st, 2025. If they are flat and positive exactly an year after, you get 15% annualized return. So if you put 100K, if they are positive, then you get 15,000. So effectively, you get 115,000 credited back to your bank account. But if it is not positive, then it goes to the quarter 1. So it is the 15th month where it will take the next dipstick check. If it is positive, then you get 15% and another 3.75% return. So effectively, you get 18.75. It is called at the 15th month. So it will go on, and at the end of the third year, for some reason, if it is not called, then whatever is the growth. Now let us say the growth is 50% at the end of the third year, that is on July 31st, 2028. Then you get a return of the gain of 75%. So effectively, for 100K invested, you get 75,000 as an gain. So effectively, 175,000 gets credited to your bank. But in the event that S&P 500 futures 35% defined volatility is negative at the end of third year, then you get your principal back, which is 100K. So this is 100% principal protection, but the next one is 50% principal protection. It's a 5-year note, the same concept. If this particular index is flat or positive at the end of an year, then you get 26.25% as return. For 100K, you get 26,250. If not, do a next check at the end of quarter 5, which is the 15th month. Then for every quarter it gets called, you get a additional return of 6.56 over and about to 26.25%, right? And if for some reason it goes all the way up to 5 years, whatever is the growth, you get 1.31%. If it is negative, as long as it doesn't go less than 50%, you get a principal back. But after that, it is one-on-one. Okay. Now the note 3 is on S&P 500 futures excess return index. It is one of the other index that is getting traded, that got traded on Friday. Here it is 100% protected, and the same concept where if it is flat or positive, it gets 12% return. But then there's an opportunity for it to be called every month. And by the way, it is a discretion of the issuer, the note 3 and note 1. And if it goes all the way up to 5 years, you get 1.5x return. If not, you get 100% back if it is negative. So it's called by Goldman Sachs. The last one that you have got is S&P 500 futures. This is issued by Bank of America. So it's a 5-year fixed term flat, and it is very good for people who want to invest on their IRAs and old 401ks and all those things, because your 100% protection comes into picture. But if there is a growth, which we are all hoping that there is a growth, then you get 1.88 times, which means that if you put 100K and then for an example, if the stock appreciates by 100%, you get 1.88 times. So basically you get 188,000 as gain. So effectively 288,000 will be credited back at the end of 5 years, assuming that there is a 100% gain, and you can calculate proportionately. If it is 50%, it is probably going to be 90% gain. Okay, but if it is negative, then you get your 100% back. So this is an update that I wanted to explain in details, and I think this is what I wanted to mention. And I think there was one question also, the single stock income notes better than compared to Ares. Yeah, Ares is an infrastructure fund, but remember there is more, it is a non-equity based instrument, and then there is also an sort of a certainty in getting the returns. Right now it is hovering at around 10%, but most importantly, Ares also works on getting a tax advantage in terms of capital gains. And then, as we all know, the present administration is hell-bent on developing the infrastructure, so that is a good potential that we have got. In fact, I was just speaking to a couple of executives who had visited us earlier this week. They did mention that they've got lots of projects in the pipeline. When they closed in 2024, it was a $750 million fund, but they're expecting to grow to around 2.2 billion by end of 2026. So they see a long pipeline of projects. So that is about Ares. I think by and large we have covered all the questions. So again, feel free to reach out to us. You have the for Jyoti, if you can go back to the last slide where it has the phone numbers and email ID, that will be good. So this is what is our contact details. Reach out to us, and then we'll be more than happy to get back. And then there are a couple of questions on NAV performance and 1031 exchange, so we will get back on that as well. That's it, Jyoti, from my side.
Thank you, Anup. Thank you everyone for attending the webinar. Wish you a happy weekend. Thank you. Yeah, bye-bye.